I bought some REITs a couple of years ago because I thought they were undervalued. Why did I think they were undervalued? Because I thought they could produce 11 or 12% in terms of the assets that those companies had, and I thought an 11 or 12% return was attractive.
Lately, there has been a significant surge in web searches for REITs, indicating a growing interest in this type of investment. It could be due to Warren Buffett's recent purchase of the largest publicly traded U.S. home builder DR Horton, as well as one of the 3 new homebuilder stocks, NVR. There's a belief that it could indicate a rebound in the real estate market. Legendary billionaires such as Elon Musk and Charlie Munger have expressed their belief that real estate faces challenges due to the availability of vacant office spaces and other problematic properties. However, several millionaires and billionaires are likely investing in the real estate market since many high-quality REITs are currently available at a discounted price. Perhaps, many individuals started considering building their own REITs portfolio to generate income from dividends for early retirement or financial freedom. Many investors tend to view REITs as investments that generate only income. Indeed, they must pay out at least 90% of their net income to shareholders to maintain their REIT status. This often results in high dividend yields. However, this does not imply that they cannot offer substantial capital gains and total returns with the potential to outperform the market. Recent share price declines in this industry have pushed valuations on many REITs to levels where very attractive safety margins are present. According to Warren Buffett, a discount essentially refers to the margin of safety in investing. When REIT stock is trading at a significantly lower price than its fair value, it is considered more than just a dividend stock, it's also a value play. In the future, when the market recognizes its mistake and corrects its valuation error, the potential for total return will increase, and investors will have the opportunity to experience significant capital growth and passive income in the years to come, due to the current negative perception of REITs. Why are REITs experiencing a decline currently? The first reason is quite simple: interest rates are on the rise. According to Benjamin Graham, interest rates should be the basis for stock valuation. He expounded on this idea in his renowned book, The Intelligent Investor. His wisdom is similar to that of their well-known student, Warren Buffett. They both hold the belief that interest rates play a significant role in determining the value of all assets, much like how gravity affects objects. When risk-free rates increase on investments such as short-term treasury notes or high-quality money market funds, the demand for REITs, considered risk assets, decreases.
Stocks are worth X if interest rates are, the long-term rate is 3%, and they're worth quite a bit less than X if the long-term rate is 7%, and there's panic in stocks if the long-term rate is 15%, like it was in 1982. So interest rates are the gravity to value, basically. Everything is worth, on an investment sense, the present value of what it's going to, cash is going to deliver in the future. And obviously, if rates go up, that present value brings the number today down.
As REITs are primarily focused on generating income, any increase in interest rates can have a significant impact on their prices. Usually, when interest rates rise, it becomes more difficult for REITs to progress. This is due to the increased expense of borrowing for REITs when interest rates reach historic highs. Secondly, the negative outlook of REITs stems from 3 misconceptions. The idea that REITs are primarily invested in office buildings, concerns about rising interest costs impacting REITs' profits, and the increased interest rates that will harm REITs' business models. A significant decrease in the usage and worth of downtown office spaces has a detrimental impact on the cities they are situated in. However, it's important to note that most non-office properties and those held by REITs are located outside of downtown areas. Although it's easy for investors to associate commercial real estate with REITs, only about 5% of the REITs index comprises office REITs. The market views REITs as vulnerable to rising interest rates and automatically devalues them as rates increase. However, they have overlooked a crucial fact. On average, REITs have a debt maturity period of about 8 years, and only a small number of their loans must be refinanced in any given year. Due to the low interest rates in 2020 and 2021, REITs took advantage of the opportunity to refinance their debt extensively, extending their maturity dates as much as possible. NNN REITs, for example, refinanced their expiring debt with 30-year bonds during that period. The interest expense will increase gradually as the debt matures gradually. Furthermore, top-quality REITs maintain some of the lowest leverage levels ever, and their maturities are well distributed, resulting in a slow increase. Over time, increased interest rates and higher labor and construction costs can greatly benefit real estate and REITs. This will result in fewer new development projects being introduced to the market. The economy operates on the principle of supply and demand. When demand increases but supply remains constant or decreases, prices typically rise. Fewer new properties mean less competition, leading to higher demand and increased rent rates and occupancy. Often, the increase in rental income can exceed the additional debt burden. This is precisely the goal of many REITs, as they have seen their cash flows rise by 10% or more, despite their valuations decreasing by 50%. The current negative sentiment towards REITs presents an opportunity for investors to enjoy steady passive income and significant capital growth in the upcoming years. Warren Buffett once said, "Fearful when others are greedy, and greedy when others are fearful." Now is the perfect opportunity to create a portfolio for early financial freedom to provide a steady income through dividends with significant capital growth. Realty Income and WP Carey have experienced a decrease of more than 20% in their prices over the last year and are currently trading below their 5-year averages. Their dividend yields are 5.39% and 6.69%. To determine if REITs are undervalued, it's important to compare its current price to adjusted funds from operations ratio to the long-term historical average. If the current ratio is lower, it's usually considered undervalued and a good investment opportunity. This information is readily available in the financials or through a quick search on Google. Currently, the price to adjusted funds from operations ratio for both stocks is lower than their 5-year average, indicating undervaluation. This presents a good opportunity for potential gains in the future. Realty Income pays dividends monthly and is the dividend aristocrat, having increased its dividends for 29 years. The company has a vast portfolio of over 13,000 properties across 85 industries. Every quarter, WPC distributes a dividend. They own over 1,400 properties leased to tenants with a net lease agreement. A net lease is a type of tenant agreement where the lessee is responsible for paying rent and additional fees, including taxes, insurance, and maintenance expenses. Since 1998, the company has been steadily increasing its dividend payout. These two established companies would make great additions to an investment portfolio focused on dividends. They also present an opportunity for significant capital gain if purchased when undervalued. If you require $4,000 in monthly expenses, one option to live off dividends is to invest $1,000 each month in Realty Income with dividend reinvestment for a period of 21 years. Upon completion of this period, you can receive an annual dividend income of $52,917, which would cover your monthly expenses. Assuming you invest $1,000 monthly in WPC and reinvest the dividends after 19 years, you can anticipate an annual dividend income of $49,151, covering your yearly expenses of $48,000. According to Graham's assessment standards for defensive stocks outlined in his book Intelligent Investor, dividend records are a crucial factor. A record of continuous dividend payments for 20 years or more is ideal. Additionally, evaluating a company's earnings growth in the past is important. For defensive investors, the annual growth rate of 3% over the past 10 years is sufficient. These two stocks exceed the specified requirements. The current fluctuations in interest rates have significantly reduced the value of REITs. This has resulted in a significant safety margin for the top REITs like WPC and Realty Income. Investors may expect to see significant capital appreciation in REITs in the coming years, with many stocks offering double-digit upside potential.
We appreciate your watching. Please hit the like button below if this video helped you in any way and don't forget to subscribe to the channel. Thanks again and see you next time.